Welcome to the CoreLogic Housing Market Update for September 2020, brought to you by onthehouse.com.au. Australian home values moved through a fourth month of COVID-induced falls, with the CoreLogic Home Value Index recording a 0.4% decline in August. Although housing values continue to trend lower from their pre-COVID highs, at least from a macro perspective, the rate of decline has eased over the past 2 months, and 5 of the 8 capitals recorded steady or rising values through the month. The Melbourne housing market remains the main drag on the headline results. Following a similar decline in July, Melbourne home values were down 1.2% in August. This was the largest fall recorded amongst the capital cities, demonstrating the impact of a worse viral outbreak to other cities, along with a larger demand-side impact from stalled overseas migration. Through the COVID period to date, Melbourne home values have fallen by 4.6%. Outside of Melbourne, the remaining capital cities all recorded slightly better conditions relative to July. The rate of decline eased across Sydney and Brisbane, while home values held firm or showed a subtle rise across the remaining capitals. The performance of the housing markets are intrinsically linked with the extent of social distancing policies and border closures, which also have a direct impact on labour market conditions and on sentiment. It's not surprising to see Melbourne as the weakest housing market, considering the extent of the virus outbreak and subsequent restrictions which have weakened the economic performance of Victoria. Regional markets have continued to outperform their capital city counterparts across the largest states. While CoreLogic's combined regionals index has lost momentum relative to the pre-COVID trend, the index has held virtually flat since May. There are a variety of factors helping to support regional housing market conditions. Unlike their capital city counterparts, which last year received around 85% of net overseas migration, most regional markets have avoided the drop in demand caused by a pause in migration. Regional markets may also be appealing for their relatively low density and lower price points. Additionally, the normalisation of remote working through the pandemic could make proximity to the major cities less of a factor in home purchasing decisions. Home sales and advertised stock levels have continued to follow the lead of consumer sentiment trends. After plunging through late March and April, consumer sentiment readings posted a partial recovery through May, June and July, before falling again in August due to the new round of social distancing restrictions in Victoria and concerns about a renewed spread of the virus, which has weighed heavily on purchasing decisions. The trend in listings and housing turnover has followed a similar path. The number of new property listings halved between mid-March and the first week of May, before rebounding 48% over the next 3 months. The recent trend has again seen new listing numbers decline, falling by 11.5% over the past 4 weeks. Home sales also fell sharply in April. They were down about a third from March. The estimated volume of home sales bounced back 49% by the end of June, but has since trended slightly lower as weaker sentiment and lower listing numbers again weigh on market activity. The low level of total advertised inventory is another factor helping to insulate home values. Through the COVID pandemic to date, active listing numbers have remained extremely low, demonstrating both a lower than average amount of fresh stock being added to the market, as well as a strong rate of absorption. So far, there's been no evidence of urgent or distressed listings starting to pile up. This could potentially change, however, as fiscal support starts to taper at the end of September and distressed borrowers taking a repayment holiday reach their 6-month check-in period around the same time. The timing of these two events could be the catalyst for a gradual rise in distressed listings, which will be an important trend to monitor. If we do see active listing numbers starting to rise and be higher than previous years, it could be a signal that vendors will need to offer up greater discounts in order to sell their home. Perth's housing market has staged a turnaround since the early months of the coronavirus. Home values fell 1.6% between May and June, with the rate of decline more than halving through July and values holding firm in August. The levelling out in the rate of decline was accompanied by a lift in the estimated number of sales. In fact, home sales over the past 3 months are tracking about 10% higher than a year ago across Perth. Perth is also showing the tightest rental market conditions of any capital city, with rents up 2% since the end of March. Perth housing values remain the lowest of any capital city, with a median house value slightly less than $462,000. No doubt the healthy levels of affordability, together with low interest rates and a generous mix of federal and state government incentives, are helping to buoy demand. In summary, housing markets are showing greater diversity relative to earlier stages of the pandemic. The earlier phase of COVID-19 saw housing markets react similarly, with both listings and home sales falling sharply and home values starting a modest downwards trend. As the virus curve was brought under control, restrictive policies lifted, state borders opened, and conditions bounced back to resemble almost normal levels of activity. More recently, we've seen a clear divergence between regions where the virus curve has steepened and where the virus remains well contained. This highlights the broad economic impact of renewed social distancing policies, border closures, and weak consumer sentiment. As we move into the first month of spring, the market is likely to be less active than normal this year. Spring is a period where transaction activity rises from both a sales and a listings perspective. Heading into spring, the trend in advertised listing numbers and home sales is trending in the opposite direction. New and total listing numbers are reducing and sales activity slipped by an estimated 1.9% in August. So far, there's been no evidence that large numbers of distressed properties are coming on the market. However, this could change towards the end of the year and into next year as fiscal support tapers and lenders become less lenient on distressed borrowers. Considering fiscal stimulus policies are set to reduce at the end of this month, and lenders will be conducting their 6-month check-ins with borrowers taking a repayment holiday, the downside risk to home values remains high. The federal budget, to be announced on October 6th, should help to provide further guidance on the direction of housing markets. Additional policy measures aimed at stimulating housing activity could help to support Australia's economic recovery. Looking forward, we're likely to see a diverse outcome for housing markets around Australia, depending on how well the virus is contained and the region's exposure to other factors such as its reliance on overseas migration as a source of housing demand. With so much happening between these monthly updates, make sure you're staying up to date on the latest property market trends at www.corelogic.com.au.